If I have to see one more dividend influencer pitching another 50, 80, even 100% passive income opportunity with covered call ETFs, I'm going to lose my mind. Funds like PLTY, HOOY, Misty, and Ulti from YieldMax are exploding in popularity because they look great on social media. People are flashing their $3,200 monthly dividend income on Twitter and Instagram and grim reapering people into these ETFs. The pitch is simple. Buy these extremely high-yielding instruments, and you get to retire early on passive income. Skip the traditional 4% yield dividend ETFs for boomers. Grab the YieldMax ETFs, and you'll never have to worry about money again. It briefs well, but it's snake oil. And I say this not as an anti-dividend guy. I do not believe in dividend irrelevance theory. I have plenty of money in actual dividend ETFs like VIG, and I completely understand the appeal and value of dividends. But these ETFs that you guys are flashing at each other, this is not what you need. Let's look at an extreme example. Here's Richie B on Twitter getting all excited about his dividends from YieldMax ETFs. He's got emojis, he's kissing his wife next to stock charts. This looks like a great time. I'm happy for him. Here he is showcasing his $22,000 dividend from Polti and a $1,000 dividend from Ulti. This looks cool, right? Everybody wants to be like Richie and get paid 23 grand a month to do nothing. But I tell you now, these investments are not what they seem, and neither are Richie's distributions. If you put your money into a high-yield covered call ETF, you are racing to get your investment back before the yield tanks and the share price drops forever with no prospect of recovery. I'm going to destroy every argument about these products being good investments. If you're a connoisseur who thinks that you're going to retire on $100,000 invested because YieldMax is going to give you 80% returns for life, put your bias aside for a minute and hear what I have to say. I'd also like to thank Moomoo for making this video possible and awarding up to $1,000 of free shares and $100 cash to new users. I'll show you guys a demo of some of their new features later. First, let's clear up what these covered call funds actually do. Their strategy is not new and it's not magic. When people invest in their litany of high-yield dividend ETFs, they say, I'm getting $900 from Misty, $700 from Polti, $800 from Hui, and so on and on. They speak as though they're getting dividend from the ETF. Here's Richie's total year spreadsheet. Take a minute and gawk. It is a fun spreadsheet. But Richie also gets upset when people criticize his investing. So I'll say now, Richie, I have no beef with you. I'm using you as the example specifically because you share everything, which makes it easy to find information. I'll leave your Twitter link in the description so you can get more follows. Now look at what Richie is showing. Tens of thousands in monthly dividend from Misty, and he also holds Polti, Hui, and Ulti. I want to reframe the logic here. If you full port into Misty, don't look at it as putting your whole portfolio into shares of Misty. Look at it as putting your whole portfolio into covered calls on Strategy Incorporated, previously known as MicroStrategy. In a covered call, you, or the fund that you manage, owns the underlying stock, in this case, MicroStrategy shares. MicroStrategy doesn't pay a dividend on its own, so to create income from these shares, you sell a covered call. That means you sell someone the right to buy these shares from you at a particular price at some point in the future. And for agreeing to that obligation, you receive cash on the spot. For example, if MicroStrategy is trading for $337, then when you sell a covered call, you may give someone the right to buy MicroStrategy shares from you next month at the $340 mark. And then you'll receive $1,970 in cash immediately for agreeing to this arrangement. If MicroStrategy goes to $400, you're still selling shares at $340 because that's what you agreed to. If MicroStrategy is $200, the person who bought the call from you will just ignore the contract and doesn't have to buy the shares at $340. Either way, you keep the almost $2,000 in cash they gave you for agreeing to that arrangement in the first place. The principle is solid so far. You get to own the stock and you make income off the covered calls. Now imagine being Vanguard with 18 million shares, with the ability to sell covered calls for $3.9 billion of premium each month, and you can see why a company would want to market a covered call ETF. Retail traders want a piece of that premium. But Vanguard doesn't manage Misty, that's the MSTR covered call ETF. That would be YieldMax, and YieldMax doesn't have money like Vanguard and can't afford all those shares. So to add some leverage to the situation, YieldMax doesn't just hold shares of MSTR and sell covered calls against them. That would be expensive to buy all those shares. So instead, they use a synthetic position to add leverage. That allows them to sell more at-the-money covered calls and generate additional premium versus just straightforward covered calls. But in exchange, they're still giving up almost all of their upside. If MicroStrategy shares go higher, Misty doesn't rise. But if MicroStrategy goes down, Misty still drops with it. Of that premium they collect for selling the covered calls, YieldMax takes their management fees and distributes the rest to Misty shareholders as dividend or return of capital, which we will expand on later. So what do we have so far? We have an ETF that uses a synthetic long position as collateral to sell covered calls and collect premium, which it then kicks back to its shareholders minus a management fee. It sounds straightforward enough, but let's talk about why this is not a good deal for the shareholder, even the long-term income-focused investors that gobble these things up. Besides, if you need to make a quick buck, I've got another solution for you. New users at Moomoo who make a qualifying deposit can get up to $1,000 in free shares of NVIDIA, plus $100 cash, and a boosted 8.1% APY on cash balances for 3 months. This is the highest reward they've ever done, and that extra $100 cash is just for Kamikaze Cash viewers. All users with funded accounts, even $1 balances, can also pick up free tickets to the New York Mets at select Monday night home games. Just go to the box office, flash your app, and they'll hook you up with a ticket in foul ball territory. I got to hang out in the Moomoo suite during the August Creator Conference and consider myself very lucky. Show me another broker that gives you free sports tickets all season long. Beyond all the freebies, Moomoo's got some really impressive features like AI-enabled trend analysis, the ability to capo George Soros' portfolio, and market insights that I'll show you throughout this video. Make no mistake, Moomoo is here to play. Thank you to Moomoo for sponsoring, and now let's dunk on some YieldMax ETFs. The first problem with these ETFs, and the one that everyone wants to ignore, is that they will always underperform their underlying stock over any appreciable time period, even after you include the dividends. These instruments sell at-the-money covered calls with 30 days to expiration. They leave very little room to the upside to grow their share value if the underlying stock rises. So if Palantir is trading for $150 and PLTY is selling a covered call at the $150 strike to collect the maximum amount of premium, Palantir may go up to $180. PLTY shareholders are not participating in that rise, and instead they only get the premium that the fund collected 30 days prior. To get out of that in-the-money short call, PLTY will roll all of its positions, often taking a loss, which eats into its share price. The share price is down 16.3% year to date, while Palantir is up 104%. On the other hand, if Palantir drops, Palti's share price drops alongside it. In no way can PLTY sustain share appreciation. And keep in mind, this decline is during a massive bull market when Palantir doubled in price. If you want an example of what happens when the underlying stock is not shooting up, let's look at TSLY, the covered call ETF for Tesla. Tesla is down 17% for the year, but TSLY is down 45%. Why? It's because these at-the-money covered calls allow no room for the stock to appreciate in share price. Any share price decline in the covered call ETF is effectively permanent unless the stock goes parabolic, and those spikes tend to be short-lived as the position rolling causes a loss to net asset value, or NAV, and dividend distributions drop the share price on ex-dividend day.
Habibi, I don't care about share price. I'm an income investor. I'm not here for growth. I only care about the dividends and total return, not share price.
I hear you. And this is where we encounter a second problem. These distributions on these ETFs will continue to decline. High Yield Hustle is telling everyone that $50,000 on Pulte and Hui are going to pay you $50,000 a year in dividends for 100% annual return. But he's wrong. This is simply not the case. All of these ETFs will pay continuously lower and lower dividends every year, with the occasional spike around earnings when covered call premiums are inflated. Let's look at TSLY for a particularly good example of this. When TSLY first came about at the end of 2022, the ETF was paying about $2 a month in distribution. Now here we are in August 2025, and the last dividend was 30 cents. That's 15% of what it used to pay, about 1/7. You're now getting in about 7 months what you used to get each month. In fact, the dividend will probably drop more over the next 7 months, so it'll take even more time than that to collect what you used to get monthly. If you add up all the dividends that TSLY has paid since that time, you get $34.26 for a total gain of $1.78. A stock that rose 90.5% has you up 4.4% pre-tax. A 4.4% pre-tax return over almost 3 years underperforms a high-yield savings account. If you really are an income investor, don't tell me that you're good with this because you only care about monthly dividends. TSLY is showing you exactly what happens when these massive green seasons on MicroStrategy, Robinhood, and Palantir go away. To pick on Richie a little bit more, he's showing you his Misty distributions. He's had 15,000 shares since March, and although we don't know his basis, we know that Misty was trading for about $25 on May 1st. So 15,000 shares was worth $375,000. It's a pretty sizable position. Now on August 20th, 15,000 shares of Misty is worth $255,000. So he lost $120,000 of share value during this window. Conveniently, Richie flexes exactly how much dividend he received from Misty since May, which is $93,935. So these screenshots of massive dividends come at the cost of about $26,000 in losses, and he still has to pay tax on the distributions. Now, no shade to Richie, this table looks great. It looks awesome to pull $20,000 a month in dividends. But even after accounting for all those dividends, he still lost $26,000. And to be fair, it looks like he traded in and out a little bit earlier this year, so we don't know his total gain and loss. But if you look at how these dividends are trending, each month's dividend is only going to go lower. Misty has sustained its payouts better than most YieldMax ETFs, but there is no denying that these distributions are not a promising trend. We might see spikes in earnings months, but that downtrend will continue. Misty will eventually be just as smoked as Tesla.
Mikey, you're overthinking. Mashallah, some of these ETFs are up 200% after the dividends. Why do you got beef?
Even where it's not the case that the covered call ETF drops significantly, we can still see another problem: how these ETFs grossly underperform the underlying stock even when they do return profits. Now remember, the synthetic position of these covered call ETFs means that they have exactly the same risk profile as someone just trading covered calls. That means that when the underlying stock drops, the covered call holder loses value too. Meanwhile, covered call sellers have very limited upside. Let's compare Palantir to PLTY, including all dividends paid. Here's the chart since Pulte's inception in October 2024. The y-axis shows the Palantir price, while the PLTY line scales with percentage change, with dividends included. Yes, if you bought PLTY, you made money. Putting your money into Palantir covered calls in October 2024 was a winning strategy. But look how badly you've underperformed Palantir. You're about 30% behind the underlying stock. And don't make the mistake of believing that PLTY is somehow defensive and that it will therefore do better during a downturn than Palantir. Look at the January to February dump, and every dip after that. PLTY is more or less mirroring these declines. Maybe to a very minor extent, Pulte loses less in total return, but remember that this chart is including dividends, which will spike during downturns because of higher premium. If we're taking a high-flying stock holistically, this 30% underperformance is not worth the very minor outperformance during downturns. Here's another example. Robinhood, ticker HOOD, is up 101%, while Hui, with dividends included, is up 64%. Again, we see that significant underperformance when Hood is rising, and very minor, if any, outperformance when Hood is dropping. Misty is also underperforming its underlying, but I'm not a complete hater, and I will give covered calls credit when they're due. We do see some level of appreciable outperformance during this bear market for MicroStrategy at the beginning of the year. From peak to trough, MicroStrategy lost almost 50%. Misty, after dividends, lost a little over 41%. So this is an appreciable about 8.5% difference in which the covered call ETF did outperform, since the covered call premium offset some of the losses. But I'd also counter this by saying that I have yet to see a single person describe covered call ETFs as a hedge against declines in the underlying. It's always talked about as a passive income instrument. No one is buying Misty to hedge their MicroStrategy shares, although that would probably be a better use of this fund, and we'll expand on that soon. And one more for good measure, Tesla versus TSLY. Tesla is up 74.5% since Tesla's inception, while Tesla is up 14.6% after dividends. But we see the same thing during these downturns. During the February to March Elon backlash, Tesla stock lost way more than Tesla, even though they both lost quite a bit. Be that as it may, I found exactly 0 YieldMax ETFs that both beat their underlying and finished green. All these posts about how much money someone is making off their covered call ETFs only give you half the story, because that's what looks good on social media. We've got Dark Miner over here talking about how his 100 share purchase of Coney in October 2023 cost him $15.97 each, and the stock has since returned $14.68 in dividends. He alleges an average dividend of $1.33 per month, but if we look at the data, these dividends are dropping. He'll more likely see less than 50 cents a share from here on. Nonetheless, this is a fun statistic. If he collects another $1.30 in distribution, so maybe 3 months from now, he will have fully recouped his initial investment while continuing to collect dividends. That's lovely. And if he got in at the very beginning of Coney's lifespan, he'd be up 132% at the time of his post. But now compare that to Coinbase itself. The underlying stock is up 329% over that same span. Of course, Dark Miner made good money. He went in on Coinbase covered calls in late 2023. That's a profitable trade. But the covered call aspect made this an extremely costly position. Despite taking on virtually equal risk as the Coinbase shareholder, Dark Miner got 40% as much return as someone who just held shares of Coinbase.
Habibi, you're still missing the point here. All I want is the payout, not the capital appreciation. So I don't care if it underperforms, as long as I keep making money.
I can understand the appeal of dividends. I got it. And I could understand slightly underperforming the underlying stock in exchange for not having to manage covered calls. I could understand that point of view if NVDY were returning 450% versus Nvidia's 497%, but it's only returning 301%. You are kidding me if you say that you are willing to give up an extra 197% of your investment to have YieldMax manage the positions for you. This issue seems to stem from the idea that you must hold shares forever and you cannot sell them. But I'll put it to you this way. If someone put $10,000 into Nvidia shares on NVDY's inception date, today, they could sell $19,600 worth of shares and still have more money invested than the guy who put $10,000 into NVDY. Check the math. Dark Miner and guys like him are boasting about almost recovering their entire investment. Meanwhile, they're about to get lapped twice by the guy who just owns shares.
Hold on, Mikey. If you sell shares, you gotta pay tax. These ETFs do a return of capital, which means you don't owe no tax. You gotta factor that in.
This is a common misconception. Return of capital, or ROC, is a tax deferment, not a tax dodge. When you receive regular dividends, you pay tax on the distribution. When you sell shares for a gain, you pay capital gains tax. Both are distasteful. When you receive return of capital, you don't pay tax on that distribution. Instead, it lowers your cost basis on your shares. So let's pretend that Coney only paid return of capital. Dark Miner paid $15.97 a share and received $14.68 in return of capital distributions. Rather than pay tax on all that, he would instead deduct that $14.68 from his purchase price. Now his share basis is only $1.29. If he were to sell his shares at $8, he would be reporting a capital gain of $6.71 a share and paying capital gains tax on that. The return of capital didn't prevent him from paying taxes. It simply deferred it until he sells his shares.
No problem for me, Mikey. Never going to sell my shares.
I have bad news. If the return of capitals push your basis to below $0, you have to start paying long-term capital gains tax on those distributions. So let's entertain Dark Miner a bit longer and assume he does cover his entire Coney cost with return of capital distributions. His basis is now $0. When Coney does its next 30-cent distribution, Dark Miner must report those distributions as capital gains and pay capital gains tax, even if he never sells his shares. You can see where I'm going with this. These YieldMax ETFs are not magic passive income instruments. They are not vehicles for you to retire early. You are not going to borrow from your credit card at 25% and buy YieldMax ETFs for 80% return so you can profit off the spread. Do not buy shares of Ulti instead of paying off your mortgage. These YieldMax ETFs are just covered calls with high management fees. They act and function exactly the way a covered call does, because that's exactly what they are. You think covered call ETFs are new? YieldMax ETFs are copying an old model. Here's one from 2013. It was all the rage in the COVID era. Every bubble you see these things pop up, yield chasers flock to them like rats to cheese, and inevitably, they come up short. YieldMax will soon be replaced by something else as people start flocking to Neos or Defiance or whatever new bright and shiny product, which will just be covered calls with more leverage or long out-of-the-money puts for crash protection. Don't get sucked into these crazy ideas from finfluencers about retiring on $100,000. Your distributions will get lower every year, and you'll underperform whatever underlying you buy. You cannot blindly sell at-the-money covered calls constantly and expect to beat buy and hold, But that's exactly what YieldMax ETFs do. And that's exactly what finfluencers are telling you to do when they recommend these ETFs. If you insist on trading covered calls, learn about implied volatility and sell the covered calls yourself at opportune times. I promise you that you are smart enough to sell a call option every few months. And if you really don't think that you are smart enough, then come hang out in our free Discord where we'll get you up to speed. Or connect to Discord through Patreon and I'll be at your service. I hope this video has opened a few eyes. Let me know in the comments if you agree or if you think I'm an absolute imbecile. In any case, thanks for watching, and thank you to Moomoo for sponsoring. Their tools really did make it remarkably easy to compare these ETFs to their underlyings.